I mean, look, it is the $3 trillion question. The reason it's a $3 trillion question is because that's the rough fair market value of privately held venture assets. And, maybe half a trillion to a trillion of that is high growth new stuff, and the other 2 trillion is mature, slower growth, SaaS and cloud companies that don't have the trajectory anymore for an IPO, but as yet have meaningful value, right? And I think that's the interesting thing, is that if it was like, I was around in 99, 2000, all the good deals went public and all the bad deals were so shit that by 2002, we closed them down, we said whoopsie, and we all moved on, right? You can move on from a $200 million, you can't move on from $2 trillion, right? So what's going to there's a huge amount of really grim industrial work that's going to have to be done on everyone's portfolio to manage these companies through to a meaningful exit. Because, as I say, you can't walk away from $2 trillion that are not only your LP's economics, your economics, they're significant big companies, and they're so big that you're not going to walk away. But it's going to be a lot of hard work. You're going to be doing, one option, you just grind your way to profitability. You look at PE exit. You look at consolidations. You're going to see some private to private where you put the 2 or 3 companies in the same space together and try and, change the economics of the trajectory. Maybe you'll see some smaller IPOs where people go, I know it's not a great market, but God, give me some liquidity. Price clears all markets. All of the above. It's going to be real case-specific, long and tiring work. But on the other hand, $2 trillion is real money, even in America.